All right, thank you for clinking of the glasses. So we're back, and we're going to kick off this afternoon, and I'm really excited to introduce this next speaker. Um, and I am so glad, earlier today, anybody who has suffered from sciatica knows what it feels like. I have been dealing with that for the last couple of weeks or so, and I couldn't stand up this morning. But I ate, and now I can stand. So I worked in government for about 40 years, and I used to always get the same old jokes from people who say, those government employees, those bureaucrats, they don't know what they're doing. They're just sitting there, eating bonbons and pushing paper from one side of the desk to the other. But I have always said, I never experienced that. I wish I could have, but I didn't. I always worked in places where people were hardworking and energetic and innovative. And I've often said that if you work for government, you have to be innovative and creative. You have to be a visionary. And, can you not hear? Okay. Can you hear me better? Okay. Can you hear me now? Okay, great. Okay. What I was getting ready to say was that I've often said that for those who are in government, you have to have a vision, and you have to be strategic, and you have to be extraordinarily smart. And this woman that I'm getting ready to introduce you to now is all three of those things and more. Annie Donovan serves as the director of the CDFI Fund at the Department of Treasury. She's been the director since 2014, but before that had a very illustrative career as for 20 years working at Capital Impact Partners, which is a national CDFI. She also served in the White House during the Obama administration and worked on a number of social innovation initiatives as well. And Annie will be here this afternoon to not only give us a few remarks, but also to introduce and talk with a panel about closing that digital divide that we've talked about and heard about earlier today. And so with that, please extend a warm welcome to Annie Donovan.
Thank you, Donna. Well, good morning, everybody. I'm going to call the panel up in just a minute, but I have to start with a confession. And guess what the confession is going to be? It's going to be delightful, this confession. So I'm going to explain a little bit of the context. So the reason Connie asked me to moderate this panel is because the CDFI Fund invested $1 million in what is now my way to credit. And when we did that, and I'm going to tell you how we did it in a minute, but when we did it, it wasn't even called Project Delight. It was called something else. And so this was shortly after I came into the role of CDFI Fund Director, and it was my first budget cycle, and Congress gave us a budget, and there was $1 million in our admin budget that said, you can use this $1 million for capacity building. And, being of an innovative mind, I was like, cool. We should really go outside the box, because the capacity building we had been doing was training and technical assistance related, and that's really good, that's really powerful, but it's not the only way you can build capacity, right? And they've given us it's the only place in the budget they've given us any kind of wiggle room. So we set off to, by the way, that's not in the budget anymore. By the way, so we set off to say, okay, we're going to run an innovation challenge. We're going to take this $1 million, we're going to put it out there, I'm going to say to CDFIs and the world, because you didn't have to be a CDFI to get this, tell us innovative ways that you're going to build capacity for CDFIs to extend their reach into places they aren't, products they aren't, models that could extend the capacity of CDFIs. And so we ran a competition, and Jeff Merkowitz is here, and he ran that competition after setting the framework that was out of my hands and in his. And lo and behold, AEO had the best. This was, panels of people who had no conflicts of interest and no nothing. And they selected AEO to take the whole pot. But there were some other things that were happening alongside that. Of course, there's always drama that you have to go through. This is why, it's funny, the image of the federal workforce is so different, because you actually have so many more obstacles to get from point A to point B. So in order to make this all work, we were fighting down some of those, and some of them were, Connie will remember, were not substantive. They were more sort of politically focused. So when the title came along, Jeff came into my office and he goes, "Oh, guess what they named it?" He said, "Project Delight." I'm like, oh my God. I mean, we were pushing the edge already. We couldn't go in with Project Delight. So that was the story of how this came to be. And they came up with a perfectly fine title of the initiative, which everybody loved, and it was one less battle we had to fight. So with that, I would like to call up the panelists. And let's see, we have Tammy Hall-Levy, who's the Senior Vice President of New Initiatives at AEO. And Tammy has been the partner with Jeff. I think she and Jeff probably worked very, very hard from our vantage point on this. Barry Whitus, who's the Deputy Controller for Community Affairs at the OCC. Eric Lawler, who's an AVP for Community Development at Legacy Texas Bank. Doug Schaefer, who is EVP and Director of Community Reinvestment at Woodforest Bank. And Jonathan King, Managing Director at JP Morgan Chase. Okay, so we are going to start with a question that goes to your motivations. So, Tammy, I'm going to start with you, and just talk for us, pick up the story from here in terms of the journey that you went through from the time that we gave you resources and where you took it from there.
Thanks, Annie. The journey has been a long one, and it has involved many of the people in the room and everyone on the panel. What we wanted to do was make sure that we were building a solution that built on what we know works today. There are referral programs that happen in communities, and the results are quite good. But what we heard consistently from bank partners and CDFI partners was that there were a lot of challenges associated with the fact that they were incredibly idiosyncratic and couldn't really scale. You would spend a lot of time finding the perfect loan officer in a CDFI, cultivating that relationship, and on the other side, cultivating a relationship with a banker. And when one of those people moved on, everything you had built and invested went away, and the business owner still needed to have that connection. And so we spent a lot of time both in the design of the project. We selected 4 CDFIs to join us on the journey, ACE, Lift Fund, Intersect Fund, and Justine Peterson, because they represented what the CDFI community looks like. Some were technologically advanced, some had multiple products. We wanted to be sure that we would design a solution that could work in almost every case with CDFIs, and at the same time, we would understand what the bank challenges were, what needed to be true in terms of delighting a customer, and in terms of being both scalable and compliant. The requirements on the bank side to ensure that customer privacy, IT security, all of the things that make this painful and somewhat tedious but critically important had to be addressed. And so the process really was working with a group of CDFIs to understand what needed to be true on their side, talking to every bank we could talk to understand what needed to be true, to identify universal truths so that we could build what we now are launching as an industry utility. Could we take the investment of working with Wood Forest and Chase to make that work for any bank? And a lot of time spent saying, well, what if we did it this way, and what if we did it this way, and trying, does that work? Does this work? How do we optimize it?
That's great. Doug, I'm going to turn to you next because you were actually the first bank in. So what was your thinking? Why did you join?
Good afternoon, everyone. Wood Forest National Bank. How many are familiar with Wood Forest National Bank? Wow, God bless
See
you
that?
all.
You've been doing some good work.
That was one of the reasons we did. We're a bank that's predominantly inside of Walmart outside of Texas. We don't really market. We're on people's way. We're where America shops. 95% of America shops in Walmart once a year and 75% once a month. So we have a small product offering, a small dollar loan product in our Walmart branches, and we're interested in helping the local economies grow. We know that jobs is the most important thing for that. So we also knew we had a lot of CDFIs that we weren't really reaching in our markets. We're in 17 states, 204 CRA assessment areas, Barry. And so when I joined the bank, it had just been right before you granted the money to Project Q, Connecting Underserved Entrepreneurs at the time, not Delight.
Actually, they won. They won the money, is it?
Yeah. And it was delightful for us. So we're a privately held bank. The employees are the majority shareholders. So we just had this natural way of really engaging in the community, and this was a really good way for us to enhance our service by really providing a life cycle of mentorship to our employees who are engaging with our customers naturally. But also helping us establish ourselves in the market as a place to go to for small businesses. So.
Great. Well, let's turn to Jonathan now because, that was also a critical decision in the developmental path here is when JP Morgan Chase came in. Can you talk a little bit about how you saw this investment?
Absolutely. Good afternoon. I think at JP Morgan Chase, I'm guessing everyone in the room has heard of it, but
We know your CEO.
Actually, we just know Janice.
Madam President.
we have, almost 4 million small businesses who we serve at our bank, and a large number of them are obviously looking for credit. And there were many times when we were unable to provide those customers credit that they often needed. And we were at a point where our bankers they knew that they could have referrals to CDFIs, but we have, like any business, we have a lot of turnover in our branches and a lot of new employees, and the people who had been around for 15 years, they might have that connection. But a lot of the people in our lending centers or our bankers, they might not have remembered to do it, they might not have known the right way to do it, and we were looking to standardize that process and make it so that it was easier for our employees, but most importantly, it was easier for our customers to get referred to the right CDFIs. And what we loved about the My Way to Credit program is one, is it was really making easy connections to the CDFIs, but two, there was a big mentorship component of that. And learning was obviously such a large part of the process, and this really helped us formalize that. And we felt good making an infrastructure investment for the whole industry to make this as a solution that would help all of us small businesses across the country.
Great. And Eric, I'm going to turn to you next because you're the newest comer, I think, or maybe even haven't crossed that line yet. But yes, talk about what.
Absolutely. Well, I am Eric Lawler from Legacy, Texas. We are a $9 billion bank just based solely in the 7 counties surrounding Dallas-Fort Worth. We've been in the community since 1952. And so, yes, I am the new kid on the block. We've gone through the diligence. We've signed the contract. Now we're doing the IT setup and all that fun stuff. So we haven't quite started to play in the game, but I can see the benefit of this as soon as I was introduced to it by Woodforest, so I can thank them again, to essentially, again, connect small business owners to CDFIs. And I'll be completely frank with you. I've been working with the same institution now for almost 14 years, and I spent about 12 of those in locations, about 4 or 5 of those as a small business lender, and I did not know what CDFIs were. I may have heard of them, but I didn't really know what they were. And that's a problem for a lot of branches with turnover, individuals that come in, and there's so much training when you come in. There's so much to learn about the systems and the product lineup and the services and just the culture. You tend to forget about the other outside options that are available to your small business owners. So this particular project makes that easy. It uses technology to make that connection simple and consistent. And so that's so important for us as a small community bank to build relationships with our clients. We have, small dollar loan program as well, and what we call a CRA small business loan product suite. But it doesn't cover everybody, and we can't help them all. And that's really primarily to serve those LMI communities and those businesses serving out of LMI communities. Well, this helps everyone, all the businesses from everywhere. So we do have an educational piece that we offer. We recently created a small business masterclass where we're educating small business owners, and we're doing a series of 10 classes. We're offering an automatic approval for a small dollar loan. So we're ingrained in that already. So this just goes hand in hand with what we do. And we're excited. We're excited to get started.
Great. Barry, I'm going to turn to you next to give us the vantage point from CRA compliance. What's the connection here?
Well, I think a lot of banks are interested in maximizing their ability to serve small businesses. It's for the larger banks. Most of the banks in this country that are over $1.2 billion in assets have a lending test, which is 50% of their CRA performance, and small business lending is a very important component of that. So one of the criticisms that we have heard as regulators coming now almost a decade out of the financial crisis is that lending to particularly the very small businesses has declined substantially. And some of that has been picked up by the non-regulated sector, merchant cash advance and the like, but at very, very high rates, very, very high interest rates. So to the extent that a bank can get back into serving this market of the budding entrepreneur, the growing small business that is not able to take advantage of what has increasingly become the mode of small business finance for many banks, which is small business credit cards, a product like this really does provide a way for banks to serve that, and providing the mentoring, the technical assistance for that potential small business borrower that may end up coming back to the bank after they've gotten their business up and running, that there wasn't a no, but it was a no but. Mm-hmm. And I think all of those components make it very intriguing for bankers to get into this. So, there's a connection both for the small business finance as well as from the financial support that the banks may provide to a CDFI or to an AEO at a philanthropic level, can support their community development investment activities as well. So there's a few ways that banks can see this as part of a CRA program.
So do you feel like it fits pretty easily into the buckets that exist in terms of how CRA credit is given, or are there some changes that should occur to allow that to happen more easily?
Well, there has, maybe all of you have heard, a Treasury white paper that's been drafted. Treasury issued this paper about a month or so ago. They spoke to 100 organizations around the country, including many CDFIs. Maybe some of you in this room were interviewed by the Treasury staff. And they issued a report. And one of the findings from the report is that banks really do want to be involved in lending for community development activities, for small businesses, outside of their traditional assessment areas. And they want to be able to get CRA consideration for doing that. They want to support CDFIs and the work that they do, even if it's outside of their assessment areas, because it's where the bank may do lending outside of where they take deposits. And right now, CRA is very much tied to the assessment areas where the banks have deposit-taking facilities and the region around that. So in answer to your question, does CRA have what it needs to have in order to really maximize partnerships between banks and CDFIs? I would say we need to do some work on that. So our controller, Controller Otting, has been in banking for 30 years before he came to the OCC. He has a particular familiarity with the CRA, and he has expressed his views. Maybe some of you have heard him speak about it or seen him interviewed in publications, but that is a view that he has expressed, and one that I personally feel, just based on the work that I've been doing in this industry for a long time. But the journey would be for the document to go into the Federal Register, laying out a concept for making modifications to CRA. It's called an advance notice of proposed rulemaking. Usually, an advance notice of proposed rulemaking goes out and lays broad themes out, seeks public comment on those themes, and then based on that feedback, getting down to actually writing a proposed rule, which again, once the proposed rule is developed, we go out and get public comment. So would really encourage all the CDFIs and the banks and others in this room that are interested in this space to participate in that process, to provide us your feedback if initiatives like this are not getting the proper CRA consideration. Hopefully you'll tell us so that we can get it right. So I think we can make this work. I think the rules today don't specifically speak to how a referral from a bank to a CDFI fits into the CRA realm, but at the same time, if a bank provides philanthropy or some other support for that CDFI to provide technical assistance to those borrowers that benefit from that referral, we have very clear rules about that type of activity. So I guess the bottom line is, for a banker that puts together a program, participates in a program like this, they should keep very good records as to who got referred to the CDFI network and what type of technical assistance they played in terms of helping that referred borrower get that loan, and then have good data points on after they made that referral, what happened to that borrower, did they benefit from the package that they were able to get by both the bank making a referral, taking the initial application, and then perhaps providing financial support for technical assistance.
Great, thank you, Barry. I want to shift to talking a little bit about obstacles, but I just want to make an observation based on a few things that Eric said. One is, who knew, right, about CDFIs? And I think, those of us who labor and have been laboring in this field day to day sometimes forget that the rest of the world doesn't really know that we're out there. But then when you look at the data on this, and you look at the assets under management by CDFIs, and you compare that to the assets under management by just the regulated financial institutions, we are just starting to round up to 1%, which means previously we were rounding down to 0. So I think we all have to appreciate that we actually have come a very long way in a short period of time. The CDFI fund just came into existence in 1994. So, we need to get from 1% to 2%, in the next 10 years. And I think, initiatives like this help build that awareness and the use of tools. But the other thing that is interesting that we talked about beforehand is that Eric, your bank didn't know about the Bank Enterprise Award Program, which is tailor-made for small banks that are making investments into initiatives like this to get rewarded through the Bank Enterprise Award Program. And that program, over the last couple years, has been notching up. This year, in 17, we had 23 million. In 18, it's been ratcheted up 25 million. And that's up from 19 million the first year that I was in this job. So just a point of awareness there.
Pointing out another thing I didn't know about, right? So I'm learning every day.
I know, it's great. You're like going up the learning curve really fast. So let's talk a little bit about whether or not there's any friction in this system. What are the points, if there is friction, what are those points? And then how are you trying to resolve them?
So I would be lying if I said at launch everything was perfect. It's very close. I think that the places where I would characterize as friction are as we grow and learn, making sure that data privacy is protected and that the customer's experience is exactly what the customer should get and must get and will get. Some of that is system build related. Some of that is the unevenness in what exists in market among CDFIs. We have 21 CDFIs today that are qualified to participate in, have been through the assessment and participate in My Way to Credit. That is full national coverage, and that's fantastic. But the CDFIs are different in their offerings in their markets, and ensuring that against the service level agreements that CDFIs have committed to, and the range of customers that are coming through, making sure that we know what folks are getting, that they're getting what they should be getting, and they're getting what they want is the critical piece. And then technology is incredibly promising and exciting, but the design and development and build we have to be thoughtful, and we are, but that's what I would characterize as small amounts of friction.
Great. What about from the banking perspective?
I think from the banking perspective, I'd say two things. One is it's off to a great start, and so much of what we do is often in get a pilot working, prove it works, and then scale up. And so I think we feel great that this is more than a pilot, but we're showing progress and we're demonstrating there's real demand and desire. So now we have more confidence to say, let's figure out how to scale this up. I think you made a very important point on data privacy in customers. And if we just think of everything that's happened with Facebook in the news and everything else, is making sure when we're making the referrals, that they are our customers that we're going to be referring to CDFIs, that one, all the data is secure, but two, it's being used the way it was intended to be used and not being used any other way. And that's something that I think has always been on our minds, but has really been brought to the forefront. And while I don't have any evidence or have seen any problems, it's something that we want to see it's built into the system to work properly as designed, as opposed to relying on lots of different CDFIs to do their own individual processes.
Tammy, I think it's worth you touching on how we protect that, because part of us testing the prototype, we spent months on this issue to really try to break the ground of how do we not share customer identifiable information, and we've had great success with it, but I know you were sweating it behind the scenes. Where have you seen, after Wood Forest, any additional things that you picked up?
So we are very careful to ensure that any data that is shared by a financial institution is both made transparent to the applicant, that we know it, and the applicant opts in. Wood Forest shares a slightly different set of initial data and information than Chase does, but in both cases and in all cases, the principles remain the same. The customer gives consent to participate. The customer is aware, adds additional information, And from an architecture of the system perspective, I'm not an engineer, but our engineers spend a lot of time with lots of technical specifications to ensure that there's a protection, and then there's a second level of protection, and the data is encrypted at rest and in motion, and the data is all kinds of things. So there's a mix of how it's shared, what the customer knows, what the architecture looks like, and how the CDFIs that are receiving the data are also committed to the use as you described, Jonathan.
I'd like to say a couple of things. So our goal when we launch is to not only send, we're going to do an email announcement to our clients, potential referrals to the CDFIs, but we're also going to send an email to our officer that did the loan application. And I think that's a key component of it to, how many times do you get an email that you don't read, right? But if your banker calls you that you just did a loan application with, you're probably going to pick up. So that's the goal, is to allow the officer to make a phone call and actually do a warm handoff to the CDFI. And I think that's not a friction issue, but the education piece of that and the awareness piece of that, I think, is. So I'm going to spend quite a bit of my time educating our employees on what this program means, how it can help them and their client. Because, we all know here, CDFIs, if we don't know, I know now, CDFIs don't take deposits. So that's great for a bank like us. If we can't lend to you, we'd love to hold your deposits and then, of course, get you credit where you can, and then come back and see us, to your point earlier, 18 months to 2 years from now when you've got your business off the ground. So the awareness and the education piece around what CDFIs are, to bring that 1% to 2% faster, right? Yeah. I think that's a key component, and having that ability to do it through technology and make it easy is, just everyone that I've spoken to on our retail side and our commercial side, they're all, don't tell me anymore, Eric, just when do we start? So
Cool.
it's great.
There are actually some CDFIs that take deposits. There are some CDFI banks and credit unions, but I don't think you have any in your program, right?
We started with loan funds
Yes,
for a variety
right.
of reasons, and
Makes the most sense.
we imagine a very robust marketplace. We'll see how it evolves in terms of receivers.
Yeah, yeah. So let's link this to the previous presentations, those fabulous presentations this morning about the lack of access to high-speed internet, and how does that show up in this endeavor?
I think the relationship between what we heard before in terms of bridging a digital divide and My Way to Credit is that as the marketplace becomes much more technology-led, technology-driven, as Joanna and Anna described, the need for parallel investment in making sure that individuals have access so that folks can use things like My Way to Credit. Mm-hmm. In addition to My Way to Credit, the range of tools and needs that can be met through internet access and digital capability grows and grows. And so solving for the infrastructure piece on the digital divide side, mm-hmm. I think empowers and expands what this solution can be over time.
Yes, great. And go ahead, Barry.
I would just add that from my perspective, and having a little bit of familiarity with My Way to Credit and its predecessor, Project Q, the real need, in my opinion, for connecting growing small businesses or entrepreneurs are in rural communities. Mm-hmm. And to the extent that you, through your CDFI network, are able to make connections between people living in rural communities with this credit option, with a mentor or some type of technical assistance, is really important in terms of helping to the growing businesses that want to grow in rural areas. And then the last piece that I think we're going to talk about in the next portion are those 23 million people that live in rural communities that don't have access to high-speed internet. And those communities are losing businesses, and they're losing residents, and they're losing the kids that don't come back after they leave the farms or those communities after having gone to college. So I really see this as an opportunity to help rural businesses, but I also see the need for high-speed internet as being a critical tool for making this work to its maximum potential.
Great. Let's pivot to talk a little bit about what the future is going to look like for My Way to Credit. Do you want to start us, Tammy?
So I think our team would love to see a world where business owners that aren't able to be served immediately by a bank find their way efficiently and delightfully to a network of community lenders so that they're getting the opportunities for credit and the path to capital services, the mentoring, the financial coaching, the pieces that accompany the choices associated with taking financing, and that they are able to achieve their aspirations because the resources that exist are accessible.
Great. From other panelists, where do you see this going?
My dream is that every bank and every CDFI is on this platform, because we aren't doing nearly enough at 1% with CDFIs to fill the gap in the ecosystem of trusted guidance and capital. Mm-hmm. So from that ideation moment to being able to get financing through most commercial loan programs to Series A, there's so many gaps. And that consistent mentorship, this just gives me great hope that we're starting to crack the code to build lifelong sustainable relationships and bring transparency to people that need it most, that are really driving our economy.
I think we'd echo many of those comments. I mean, one is just more institutionalizing this referral process, and right now we have it with many of our loans, but not all of our loans, and making this a piece where it just automatically happens, and so it's built in. And customers expect, if we just think of how consumers are and small business owners, for things to be seamless and not to have to pick up the phone and get referred and find an email over here and find it over here. Have it just all work well together and do that. And I think that mentorship point is one that surprised us even looking at the data. Was, as Andrew mentioned when he spoke earlier, that we've got more than twice as many people are asking for mentorship even than are asking for the loans. And so building that process, because if we delight our customer, even when we're turning them down from our side of the loan, by putting them in touch with people who can help, they'll remain lifelong customers with us at Chase, which is good for us and good for the business.
I'm just going to say I like the way that Delight has actually survived. It's a brand. It has a life. It's,
I was just going to point out that right now, My Way to Credit doesn't talk to our lending system that we use for small business lending. I would love to see that happen in the future, to your point, to make it all-inclusive and make it simple and easy. So there is a manual component to that part, but I know that I'm sure in the future there'll be more activity on that end so that it's just built into these different systems, so these various underwriting programs that are out there. If that happens, my goodness, it just makes it turnkey when you start using an underwriting processing system. So.
Yeah, great. Donna, do we have time for a few questions? Okay, let's see if there are any questions from the audience. Yes, go ahead. Yeah.
I don't remember all the names, but the gentleman 2 spaces from you who said, his bank, he mentioned at the beginning. Your bank is located where?
We are, Texas is where 85% of our business is, but we're east of Texas along the Gulf all the way up to New York, Ohio, Indiana, West Virginia, Kentucky. So across the Gulf states.
Not Michigan as well?
Not Michigan. We stop right. Although I am familiar with this room, I worked at GMAC for many years.
Okay, the reason why I was asking, you're affiliated with Walmart, right?
Not affiliated. We rent space from Walmart.
Okay, so I don't have a question.
Did I get that right?
Disrupt the panel.
Okay. All right, we had a question over here. Yes.
My name is Amy Williams. I'm with Mountain Association for Community Economic Development. And my question is, as far as the referral
Good question.
Screening those out for the CDFI.
Yes.
I'll speak for Wood Forest. We send every declination through automatically. So we're a small dollar, we're not sending through, but small dollar loan product. And so our buy box is pretty big. We go somewhat low on the FICO spectrum. So, and it's very automated. So it's very automatic for us. Everyone goes through. And what we love about the whole program is we're able to see where the handoffs are, great tracking, great measurement tool, especially as we grow this capacity to do and help customers in the small business space through our branch network. So, did I answer your question? Yeah.
And we likewise refer, I'd say we refer almost everyone. If we are declining someone for fraud reasons, for example, we will filter those out. So there's a couple of very basic filters we have, but other than that, we're essentially referring all to My Way to Credit.
I would echo those as well. However, we do have a system limitation with any loan that we have that comes through that's over 500,000. So right now we're just referring anybody denied under 500,000, but we're actually quickly remedying that through our other, because there's, again, I spoke about the systems not speaking to each other. The one that we use is over 500. We're enhancing that product soon. So soon it'll be everyone.
So were you able to get over this double decline problem? I remember in the early days that was an issue that some banks were worried about the double decline.
Yeah, one of the things that I described earlier that our process was talking to as many potential referrers as possible. The double decline was something that was universally seen as almost as bad as anything else. And so there's really three things that we do to avoid the double decline. The first is by offering mentoring and other services. Everyone who comes to the platform gets something. And as Jonathan and Andrew described earlier, we're seeing a surprisingly high uptake of mentoring. The second piece is the way that the system is designed. CDFIs create profiles of the customers that they can serve well, and those customers are a mix of the credit box, the customer, the owner's characteristics, and the business characteristics. And by filtering against those characteristics, we're increasingly better able to make right fit matches. And so the notion that everyone can opt in and everyone can be matched to what she needs is largely the path to avoiding a double decline.
Great. It's interesting to me just to hear the thread of conversation around mentoring, because 3 years ago when the CDFI fund made its investment, or when you won that award, fintech was just starting to explode, and it's gone through a cycle pretty quickly of hitting the wall and hitting some issues, and at that time there was just a lot of talk about frictionless lending, and that didn't factor in any kind of mentoring or high touch dimension. And it's really interesting to see only 3 years later that what's emerging as a competitive advantage here is the high touch piece of it. It's just interesting to note that maybe high touch combined with technology is where we might be meeting in the middle might be a stronger solution, and CDFIs really have something to bring to that. There was a couple questions in the back.
Just going back to the question about who you refer over, does that ever, or has it ever created a challenge for capacity for the CDFIs? Like if you had to chase everything over, does that overwhelm a CDFI like this, or has it happened?
We have a few CDFIs in the room that are members. Maybe best for Jamie.
So far nobody.
Okay,
So
that
far,
was a quick answer.
We haven't experienced the challenge of overwhelming a CDFI. One of the elements of the system design is that the CDFI can control the campaigns it creates, and so the spigot, as it were, can be turned on and off on both sides. That means that a new campaign could be quickly generated to serve, you suddenly got a pot of money to test a new product for women. You could create that profile, you could turn that profile off. The good news is that so far, as Gary attests to and others would as well, we haven't had the blessing of the challenge of overwhelming CDFIs. We're in good shape.
Yes, we'll go back there and then up here. Janie.
Right now, you've got to opt in. The customer has been turned down and must opt in to reach a CDFI. Do you ever see a time when it'll get automatic second look? Because then we will need, once that spigot is open, then we are going to need cash to see the rebate.
So you could easily imagine, and we whiteboard it all the time, a universe where some CDFIs have the capacity to take a credit model and immediately decision a business owner whose profile comes through. Others do not, and some business owners will be easily approved with that, and others will need more of a conversation and will want more of a conversation. And so you could imagine in the evolution of delighting customers, meeting them where they are, a fast yes, a more engaged dialogue toward yes, and a lot of services like mentoring to help them get even closer to yes.
We didn't address anything about the legal part, and that's a big issue, right?
All of the legal questions do and will get resolved in order to achieve that vision. I don't think that our vision or our aspirations are the constraining piece. And to date, we haven't seen any challenges that aren't solvable. So is it easy to overcome the constraints around privacy? Not necessarily. Are the rules around fair lending very clear, and do we comply with all of them? Absolutely. I may be an optimistic entrepreneur, but I think that with the right people at the table and the right mindset and vision, we can solve for everything that needs to be solved for. Will we do it tomorrow? No. But will we do it? We can.
Come up here, yes.
So I'll build on Janie's very good question. So you spoke about friction, and first of all, compliments, as an AEO board member who has pushed and challenged Connie and Tammy and team to move forward. It's just gratifying to see so many adopters from the regulatory side to the practitioner side and also the financial institutions. But if you take a moment and think out 2 or 3 years, and you reference friction and eliminating friction, where are the next key investments for enabling more folks to adopt this in a way that will get at the heart of what we're trying to solve for? Access to information and capital to propel these businesses forward. Is it on the IT level? Is it enabling the communities where the CDFIs are on the maps that Joe Dennis showed? Where is it? Have you afforded yourself the opportunity to look at that?
I think we think about it often. I think on the platform side, you can imagine more standardization, harmonization, a common application perhaps. We spent a lot of time in the front end of the design of the process with CDFIs to understand what do you need to be able to make a rapid decision, what do you need to avoid a double decline, so that we're asking for that once from a business owner and pushing it across. I think outside of the platform, we see a lot of opportunities to work with ecosystems that are emerging and exist in communities to bring together both sides of the equation, the platform on one side and the platform serving to support the ecosystems and activities that are underway. The kinds of services that we think of as path to capital services, in some cases, they exist in a community. In other cases, it's a matter of bringing them there.
Let me just extend that question to the bankers. What are the things that would compel you to ramp up your participation and investment in the program? even more so than you're doing now?
I don't know if we could do more.
Good, we maxed you out.
As our business grows, we intend to continue to leverage the platform to its fullest, and we have a lot of auto filters on what gets even just a valid application that's ruling out all the stuff on the front end as part of our automated systems. But as we grow, we intend to leverage. This is an integral piece to our service delivery system and trying to meet the challenge in rural America. Just to give you a flavor, we've got some single branch assessment areas to talk CRA speak for a moment with. I was looking at a performance context earlier today, Barry. We had $180,000 in the assessment area in deposits. So we've got some very shallow economies that we're trying to support and bring this technology to really help.
Wow. Yeah. How about Chase?
So I think we're all in with this as well. The piece that I think we would like to see is a better understanding of why many of the people that are referred don't actually choose to go through with the program. And if we look at our data, the majority of people with that referral from us never click on the link and never go to it. And then when people get there, and we're early days, but if we could actually be more efficient in getting people to whatever it is they need, I think that will be actually the bigger issue as opposed to looking for us to get
Yeah.
more. It would just be getting people
Get
through the pipeline.
the motivation, yeah.
Yeah.
Did you want to say something?
we're as I mentioned before, we're just getting started. So once we really get in and see the impact and are able to see kind of the back end stuff, the data record retention, to your point, Barry, earlier, to be able to record the impact and understand what the story is after we refer. If we can see some more of that, I think that and how it's impacting the community, I mean, we'll put more into it than we are today. Absolutely. Yeah.
Well, so we're just about at our time. Does anybody want to make a final remark? If not, I will, and I will say that thank you for working this out, because we went out on the limb to say that we didn't know what was going to become of this innovation challenge, but we knew that CDFIs had it in them, that if we made this kind of investment, something really great in terms of capacity building for our sector would result on the other side. So thank you for proving our hypothesis. So let's give a round of applause to the panelists. Thank you. I don't think so. Okay.
Before I forget, I just want to give you a card.
What's that?
Appreciate it.